portfolio inflows that had hitherto avoided Nigerian market started to return to the market, and we saw the significant rally that we had. And historically, January has also been a lightly positive month, say for the last 3 years, which have been quite peculiar with the issues of FX that we've had. But January has been lightly positive. It's even termed the January effect. When you see this is
more than January effect. This is more than January effect.
Increased buying in the market,
because the appetite really didn't slow down. Technically speaking, all through the Christmas, all through the New Year, and looks like everybody just came back with this hunger under the belly, and they just wanted to keep pricing. And folks said, well, we're still, in terms of forward price earnings multiples, that we're still we're still a cheap market. And then, so you got your dollars, you can move in and mop up.
Yes, I mean, even from a foreign investor's point of view, if you consider the fact that the Naira was the value of Naira depreciated in prior year. So in dollar terms, it actually became cheaper for them to buy our assets. But the thing is, because of the issues that we had prior to the launch of the Investors and Exporters FX window, where we saw a lot of sell-offs across the market, we saw a lot of Nigerian stocks significantly undervalued in comparison to peers. So valuation that we're seeing in the market wasn't necessarily reflective of the fundamentals of these companies. So what we've started to see now is valuations have improved significantly. So now a lot of investors will be turning towards actual performance of these companies. And like I mentioned, the expectation is largely positive. So there's that chance that the rally will be sustained up until we start to see results.
And then we saw a massive rally in the fixed income of 2014, 2015, 2016, because as folks were dropping, they were selling out of equities portfolio, they were picking up fixed income in the run up to the 2015 general elections, and that continued because folks believe that, look, let's go long on this country, let's hold this. And the government was really in a very tight corner, borrowing massively, so yields just went, ooh.
Yes, I mean, with the weak appetite for equities, the one destination that funds started to go to was fixed income market, where you have reduced risk, and even yields at the market surged. So it was quite attractive for investors, with a lot of portfolio managers overweight on fixed income markets as opposed to equities. So that significant interest over the past 3 years has remained. And then in 2017, when we saw the pick up in sentiment for equities, we started to see some slight tilt, but a lot of it, portfolio managers still remain overweight on fixed income market, not just as overweight as it was in prior years.
When we say fixed income, what does it represent in an economy? Fixed income, basically treasury bills and bonds. What does it represent in an economy when we talk about that?
Well, basically, in terms of valuation of these instruments, so you can get a sense of what level of risk is, how investors view the country and the economy as a whole, in short term, medium term, and long term. What we saw, if you look at the yield curve last year and even the prior year, we saw that at the shorter end of the curve, yields were higher, which means investors were pricing in higher risks at the short end of the curve as opposed to the longer end of the curve. And what you have normally is the longer the tenor, the higher the risk should be. But what we saw in the market was a reversal of that situation.
So the risk pricing
was basically on the short end. But now we've started to see some normalization in the market. Short-term interest rates have started to decline, with the CBN sort of guiding short-term rates lower at the end of last year, with the cessation of the OMO mop-ups that we had, which were at higher rates. So what we've seen is short-term interest rates have reduced significantly. Average T-bills rates currently stand at about between 13.5 to 14% thereabout, as opposed to what we had last year, where we had 18, 19, 20%.
I saw 20. I saw 20 last year. I'm sure you saw it. You see the numbers more than I do. But what exactly do investors want under the new regime that the Kemi Adeosun's team with the DMO and the central bank sort of come together, the guys who are guiding the financial services industry with the government, of course, handshaking them to look, we need to rebalance the treasury bills portfolio. We think it is too big. We think we need to squeeze a bit. We need to spruce it together a little bit, reduce our borrowing costs, and move on. What do you think investors would want under this new dispensation that is beginning to emerge? Of course, we expect a full unveiling of that in the current year.
Well, I think a lot of investors would still be waiting to get some sort of clarity as to how the markets would go. Like you mentioned, we saw significant borrowings rise significantly over the past year with the need to finance the debt, the deficit side of the budget. So we saw a lot of even domestic borrowings also increase. But what we had closer to the end of the year was the announcement that they're going to tilt towards foreign borrowings in order to reduce which were cheaper in comparison, in order to reduce the debt servicing burden. Because I think from in 2017 we had a debt servicing to revenue ratio of about 60% thereabout, which was quite worrisome.
We have about 2 minutes before we end this first part of our conversation, looking at the market's playbook in 2018. But what is my long end and where is the short end of the market? Do I play this new regime?
Well, basically, a lot of investors are still playing at the two ends of the market. So we have investors taking position in the fixed income market and in the equities on the other hand, in order to sort of balance the risk in the portfolio. There's still opportunities for gains in the equities market, so we have investors that are still there. But on the other hand, you have to hedge your exposure by taking position in the fixed income market. But we've started to see a lot of interest on the longer end of the curve, and we've seen a lot of investors take position there.
Okay, when we come back, Romosele Aziba will still be here to take us through AfroInvest's new research report they're about to release. We hope that should be coming on the street this week. We've seen a number of these reports coming through and everyone talking about it. So let's get us an insight into that. And if you are a local retail investor, we'll have some advice from Romosele when we return.